name is John Baptist Gichuki, work in Credit Bank as a head of trade finance. These are solutions that facilitate or support the normal buying and selling in a local market and also internationally. The difference is one and the same because trade finance is where we are saying is the facilitation. Trade as a business is the business you are doing, the business of the buying and selling. If you are a trader or if you are a contractor, that's the business you are in. But the financing, the difference here is the financing, which the financing here is where the bank comes in to facilitate that kind of business. So that's the difference between the trade business and trade finance. This would have a variety of various people in the various sectors. And here we mean a contractor, a supplier, a trader. Anyone in the normal business of buying and selling has access or can get trade finance, can get solution to facilitate his business. In any transaction, it starts with the negotiations between the buyer and the seller, or between a procuring entity and the contractor. And basically, they will have agreed on the terms they want to happen with. For example, and now the trade finance comes to sort out the gap. So long as there is a gap between the buying and the selling, because assuming I'm a trader, I'm buying good X to sell to Y. Where I'm buying, there are terms that we have agreed. Where I'm selling, there are terms that are agreed. But in between, there's a gap. That's where we come in. Entirely, when you're looking at trade solutions, you have to look at the working cycle. If the cycle will not be complete from the time of procuring, from the time of processing, from the time of distribution, from the time of cash collection, okay? If there's be any gap, and when I mean gap is the financing gap, that you could be, or there's a mismatch between what is coming in terms of revenue and what is going out in terms of expenses or purchases. That's why most of those people now will require a financial. That's when they approach the bank, because in the cycle they are dealing with, there is a mismatch of coming in and going out. Otherwise, if it was a cash basis, I'm buying cash here, I'm getting cash here, there will never be a mismatch. But so long as now you're in the normal business of trading or buying and selling or providing services, they are likely to appear such financing gap. That's when those people come to the bank. Okay, when we are proposing any solutions, we look at that cycle, and there are very many solutions within that. We can categorize them into two categories, what we're calling the non-funded or contingent, and the funded. The funded are like the small loans, but basically they're on a short-term basis. I give an example. Invoice discounting is where you have supplied and you're waiting to be paid because you have allowed a credit, but you need some cash flow or some cash to proceed and make other purchases for other contracts or for your normal business operations. So at that point in time, instead of waiting your counterparty to pay you, you come to the bank and say, hey, I'm waiting for this payment which is payable in 30 days or 60 days, but I need some cash to continue running my business. So that will be an invoice discounting. So it will be a funded facility, though in short term, matched to the expected receivables coming through via that invoice. There are other people that will require instruments like guarantees, where he can access goods on credit, but the seller wants a guarantee that payments, if I give this guy credit within 60 or 90 days again, he's going to pay me. So you may be able to issue an instrument. Others is like letters of credit, where basically we're facilitating you to import via an instrument of the bank, where we are giving the seller and we're giving him a conditional undertaking, telling him, you supply to my client, provide the following documents or meet the following terms and conditions, then as a bank, I'm going to come and pay you. So we can categorize them in two ways, in those two areas. Others has contracts and they need some mobilization or some advances to be able to execute those contracts. So at that point in time is when they'll come to the bank to get some advance or some financing to be able to execute those contracts. So there's a variety of many solutions that will come depending on what level of that gap is coming from, whether it's at procurement point or is at the end of the process. For each business, we look at it differently because the dynamics of every business is also differently. Therefore, we have to structure or give solution differently to that that address the specific gap in that business. Otherwise, it can't be just generic. Okay, some are generic, but on many cases, you have to structure it to fit in within that particular gap. For any requirements or for any solution to be whatever, there will be a normal appraisal process that the bank has to appreciate what is the transaction all about. So there has documents to deal with who the customer is, what we normally say KYC, yeah, and then there will be the transactional documents to support what the transaction is all about, because in trade finance you have to support, or we are guided by the underlying transaction, okay, whereby I'm buying this and selling here, I have a contract. So that contract is what we'll be so much looking at, if that is whatever. If you're importing, then it will be the issue of the pro forma invoice, and whatever you're doing has to be within the core business that the person is doing. So we'll do a bit of appraisal for us to appreciate the transaction, and then point out the various risks that are likely to happen. Then we see how best to mitigate and try to minimize those risks happening. So then we're able to offer that solution at the end. There are many advantages, and so much is because everything is aligned to the transaction or the underlying transaction and with the underlying business model. If you came for a normal, what people appreciate as a normal overdraft, even me as a bank, I'm exposed to the extent I have no control of what you're going to do with that money when the limit is marked in your system. But when you come to the bank and you're asking for, say, a guarantee, okay, as much as you're going to give the bank some comfort, that guarantee is addressing that particular need in terms of your supplier requires a guarantee to be able to give you a credit, which now the bank comes to give. The other bit is they are short term. All the funded facilities, they are matched to the receivables. So if you are getting, or you have supplied goods waiting for 60 days, I'll give you a facility equivalent to the tenor of that 60 days. So on this 60th day, my first point of reference will be the payment coming to offset that facility. Okay? Therefore, it may not even be a facility that has to be required to be paid on a monthly basis, because every transaction has to be what we call self-liquidating. It has to match. If I paid on your behalf, there's a receivables expected on a particular day. So I match the two. So even from a customer point of view, it's a solution that is also giving you space to go and do much more, concentrated on what you do as a core business, compared to every month or every now and then you have to think, oh, I have a bank facility, I need to pay up by end month or by this particular day. So you have to get worried of where receivables will come. But these solutions, basically, because they are structured, specifically structured to address that particular gap, you find they are well matched. You know you're expecting payment in 60 days, that's also when the facility of the bank is paid. The receivables come, they offset, and that's it. You're done. Yeah. Basically, I think what we're even going ahead to do is you find how the person does the business. Most of the people have the mentality of just getting the normal bank loan. But when you discuss with clients, then you're able to advise them that you can use these other measures or these other solutions or these other instruments still to achieve the same whatever in a bare minimum with a cost reduction. Because remember, a bank loan, you have to take it now and you start repaying on a monthly basis. Currently, the interest rate are around 13.5 per annum. But with such instrument, you only pay some commissions. So, and commission on average, they will not be maybe more than 2%. So when you look at it, then it's also a saving cost to the customer, and also stress-free for him, because he'll not have to think of so many issues or whatever. He will be able to concentrate on what he knows best and all that. So the uptake of late people are appreciating, especially when it comes to the contract business, in terms of before you get to the contract, there is a bidding bit, there is a performance and all that. So the uptake, I would say, has not been very whatever, but there is so much education that is being out there. advisory, and this would happen so much if all financiers are able to engage clients and advise them of these other solutions other than the normal conventional banking that we know of. Yes, I would recommend trade finance anytime. Of course, there are those transactions we will not be able to do, but you'll also be surprised even at the project financing levels or project financing transaction, there's a trade finance component into it. Yeah, because you may have to issue instrument for purposes of importation of some materials. Even locally, people are appreciating that you can use instruments to be able to trade between each other, and that also reduces a lot of cost between the two parties. And when the banks come in, because they are facilitating, one is able to take a risk on the bank other than dealing with the respective party or the counterparty that he was dealing with. The bank comes into intermediate between the two parties, and therefore it gives everyone a comfort that I can do with every other instrument or any other solution, so long as the bank is also involved.